Hello, and welcome to your Daily 5. My name is Greg Harmon. I'm the founder and president of Dragonfly Capital Management. At Dragonfly Capital Management, we manage portfolios for clients. We do that using technical analysis and options trading strategies to minimize risk and maximize opportunity in short term, and run these in separate accounts for clients. We also, for those of you that prefer to dabble in managing your own money, sell a newsletter that talks about detailed events about how we see the market, how we see specific trade ideas for the week, and how we trade with triggers, stops, and profit margin adjustments. If interested, you can find out more at dragonflycap.com. Today, I've titled our presentation to be Clouds Building Ahead of the FOMC meeting. So next Wednesday, the Fed Open Market Committee meets. Widely expected that they will raise rates by at least 75 basis points, maybe 100 basis points, at least if you look at the Fed funds futures contracts. And what does the broad market look like heading into that event? What's been taking control of markets this past 9 months that we've been in a downturn? Or if you want to call it a bear market, a bear market. The main culprit, I believe, has been the US dollar. So the first chart I have to take a look at today is one of the US dollar index. You can see this is on a monthly basis, and that the dollar index has traded in some very chunky kind of channels. We had this symmetrical triangle from 2004 to 2015, a breakout that took us up to the level that we kind of circled around from 2015 up until the start of this year, 2022. And if we look back even further, around the middle of 2021, the dollar really started another trend higher, kind of like what we saw in 2014. And it seems as though we're back in that path again. Now with the dollar index being up around the 110 level, trading at 20+ year highs. Will it continue to go higher? It kind of seems like it's ready to do so. Hidden underneath the moving average data over here is the prior top around 120. So I'd say that that's not out of the question target in this move. My analysis has shown that these kind of chunky patterns tend to last for about 7 years before they start to change. So we could be in another move that moves up to around the 120 range and stay in that area for about 7 years. That would be very interesting in terms of the impact to the US markets and to the world interest rate scene. But probably most interesting right now is that the path to get there might be one that's filled with a bit more pain until it gets there. The next chart that I wanted to focus on is the Treasury ETF, the 20-year Treasury ETF. And this also is on a monthly basis, going back to the era of the financial crisis. And you can see that it didn't do a whole lot. It kind of drifted higher from 2011 into 2018. But then we embarked on a bullish shark pattern. This is a harmonic pattern here where we've got the A, B, C, D embedded. I like to look at them in terms of they create either an M or a W. As long as that the retracement levels fit within ranges. So over 0.382 here, under 0.681 here, or 682, sorry. And we've managed to stay in that range. The target for this pattern before it reverses is 113% retracement of the full pattern. So from here to here, which would take us down to about the 102 area. 102 happens to be a solid or close to the 2013 low. So I'd say that that's probably a decent target to look at in terms of how far bonds will go. and therefore how far bond yields will rise before we see an end to this. So we've got two things working now. We've got long-term patterns that show a rising dollar and falling bond prices, so rising interest rates as well. Looking a little bit closer at gold, gold has also been in a bit of a longer-term pattern. We saw it reach a high in 2020 back here in August. Came back down to support levels that it saw in 2020, where it hit this in early 2021, bounced around a little bit, went back up to retest the high earlier this year, before coming back to support by the 200-week moving average, both around just above 1675. This morning, it cracked down below this, down below the 200-week and down below that long-term 2-year support level. If it continues to hold and continues to move back down lower than that, we would look at this as a big topping pattern where we've got a double top in here, and the confirmation would be to break down below this support level at 1675. And at that point, you look for a target somewhere in here in the 1450 to 1480 range on gold. Full disclosure, I'm short gold at this point via being long puts into mid-October to play this trade. But we started the conversation with what's the impact on the market, what's been driving the market. When I look at the NASDAQ in the form of the QQQ ETF, looking from, again, on a weekly chart, from the pandemic low in March of 2020 to the high in November of 2021, we had an initial retracement of just over 50%, around 55%, before it bounced up and got stalled out at the 100-week moving average and then started falling back. Coming into last week, the end of last week, we had this large up day that kind of looked like maybe we would have been creating a higher low after a higher high coming off this bottom and signaling the potential for a reversal pattern up higher, and maybe the bottom was in June. Unfortunately, with the CPI news that hit on Tuesday and a large gap down and a continuation lower this week, and you can see this is as this price of 291 is as of Thursday's close. We're now trading a bit lower than that too, down another 1% today, making new lows, new 2-month lows, and coming back up underneath that 50% retracement level from the pandemic move higher. This bodes for a much stronger case for a retest of the June lows. And as we start approaching those June lows again, you can see this 200-week moving average also kind of pulling right into the picture here. Momentum is definitely turning lower here. So it looks as though we still have a lot more weakness potential in the market over the next 4 to 6 weeks at least. And finally, looking at that same period from the S&P 500 via the SPY ETF, the move up, you can see that the drop back in the S&P 500 was not quite as far. It did not make it down to 50% retracement before moving back up. When it moved back up, though, it had retraced 61.8% of this drop. So the drop from the January 4th high to the June low, this movement back up retraced, 64% of that, 61.8% of that, before falling back and retracing 61.8% of the rise as well. Again, the same thought coming into the week that perhaps this might be a higher low and therefore creating the possibility of a trend reversal, a major trend reversal. But you can see here already the building of a bearish engulfing candle for the current week. And with last night's price of 390, as I'm recording this now, it's more in the 385 range. So down here below that 61.8 and setting up a 2-month low for the S&P 500 as well. So the same initiative that we talked about with the Qs, the possibility of a retest of the June lows back in here again around the 360 level. It also looks as though if that takes a few weeks, that the 200-week moving average will probably be at about that level as well. So in summary, there are at least dark clouds looming before the and into the next FOMC meeting on September 21st, and still not a time to look to be putting all your money into the market this time, but playing defense and possibly playing the short game. That's my Daily 5. Thanks for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.